This represents the most crucial 48 hours in global finance. Halt everything. What transpires in Tokyo on February 11th will determine whether your portfolio survives the next 6 months. On February 11th, the Bank of Japan announces its policy decision. They will either continue monetary expansion or they will increase interest rates. And that single decision made by a small group of bureaucrats in a conference room in Tokyo will trigger a chain reaction that restructures the global economy. This is not exaggeration. This is mathematical certainty, because Japan is not just another nation. Japan is the cornerstone, the foundation beneath 40 years of global easy money. And if that foundation fractures, everything collapses. Japan has been combating deflation for 3 decades. Since the asset bubble burst in 1990, Japan has existed in a deflationary spiral. Prices falling, wages stagnant, growth absent. So the Bank of Japan did everything. Rates to zero, then negative. Trillions of yen printed, government bonds purchased, corporate bonds purchased, stocks purchased, ETFs purchased. The Bank of Japan became the largest shareholder in the Japanese stock market, a central bank operating like a hedge fund. All of it to generate inflation, all of it to halt deflation, all of it to restart growth. And for decades, it didn't function. Then something transformed in the last 18 months. Inflation arrived, not from domestic strength, but from external shock. Energy costs, supply chains, commodities, a weak yen making imports brutally expensive. Suddenly Japan is witnessing 3% inflation, 4% the highest in 40 years, and people who lived their entire adult lives with stable prices are panicking. Their wages aren't keeping pace, their savings are being eroded, their standard of living is declining, they are demanding action. Now the BOJ is trapped. If they continue printing, if they maintain rates near zero, inflation accelerates. The yen weakens further, imports become more expensive, the cost of living spirals, political pressure explodes. But if they halt printing, if they increase rates, they trigger the very deflation they've been fighting for 30 years. They crash the stock market, they destabilize the government's finances, they fracture an economy constructed on perpetual zero rates. Because the moment you alter that assumption, the mathematics breaks. Here's the mathematics. Japan's government debt is 240% of GDP, $10 trillion of debt on a $4 trillion economy. Highest debt to GDP of any major country globally. The only reason Japan can service that debt is zero rates. But if rates rise from 0% to 1%, interest costs jump by hundreds of billions per year. At 2%, another 100 billion. At 3%, Japan is burning $300 billion annually, just on interest. More than defense, more than education, more than healthcare. At that point, the government prints to pay interest. Printing fuels inflation. Inflation forces rates higher, and the spiral feeds itself. And this isn't theoretical. The market is already pricing in hikes. JGB yields are rising. The 10-year went from 0% to 0.8% in 6 months. In Japan, that is an earthquake. And the tremors are spreading because Japanese pension funds, insurers and banks are examining rising JGB yields and thinking one thing: why take currency risk abroad? Why buy US Treasuries at 4% when you can buy Japan at 0.8% without currency risk? Why pursue US stocks at premium valuations when Japan is cheaper and the yen is strengthening? Capital comes home, repatriation begins, quietly, steadily, relentlessly, and that is devastating for US markets. If you want exclusive weekly videos showing the exact stocks I'm buying, the step-by-step millionaire blueprint, and how I position before the crowd recognizes what's coming, the 100x Club is where it happens. It's in the pinned comment below. Now, Japan owns $1.2 trillion of US Treasuries, the largest foreign holder of US debt. For decades, Japan recycled trade surpluses into treasuries, financing the US deficit, keeping US rates lower than they should be. But now, that dynamic reverses. When the largest buyer becomes a seller, prices fall, yields rise, and rising yields mean higher borrowing costs for everyone. Mortgages, corporate debt, credit cards. The US economy is constructed on cheap credit. Cheap credit depends on steady foreign demand. When Japan steps back, the cost of money in America rises. And when the cost of money rises, asset prices fall. Stocks fall, real estate falls, everything reprices lower. But it gets worse, because Japan isn't just buying treasuries. Japan is the engine behind the most important trade in the world, the yen carry trade. The carry trade is leverage. It is borrowing yen at near zero, converting to dollars, and buying anything with yield and upside: US stocks, emerging market debt, real estate, crypto, venture capital, private equity. The yen carry trade has been the hidden liquidity source for global risk assets for 15 years. Every dip had a bid because cheap yen money kept flowing into the system. Now it unwinds. As Japanese rates rise, as the yen strengthens, the carry trade stops functioning. If you borrowed yen at 0% and the yen strengthens 10%, you lose 10% on currency alone. With leverage, that loss is fatal. Margin calls hit, positions are forced to unwind, and forced unwinds mean one thing: selling. Selling US stocks, selling crypto, selling risk, then buying yen to repay the loan. And when everyone does that simultaneously, it becomes a liquidation cascade. Prices crash, margin calls intensify, more forced selling, lower prices, more margin calls, a self-feeding spiral. You're already witnessing the early signals. The Nikkei down 8% in a month. Japanese banks reporting losses on foreign currency exposure. Credit spreads widening on yen-denominated debt. Yen volatility spiking. These are the tremors. The earthquake is February 11th. The Bank of Japan announces its decision. They either hold and keep the bond buying machine running, or they raise rates even 0.25%. And that single signal moves trillions in seconds. The speculators are positioned, the algorithms are armed, the entire world is waiting for one sentence from Tokyo. If the BOJ holds steady and signals continued accommodation, the yen weakens, the carry trade gets a reprieve, risk assets rip higher, stocks up, crypto up, everything up temporarily. Because inflation doesn't halt, pressure builds. The eventual move becomes larger. The break becomes sharper. If the BOJ raises rates by 0.25% and signals gradual normalization, the carry trade begins to unwind. Selling hits first, volatility surges, then the market attempts to stabilize as traders realize the BOJ is managing the path. Weeks of choppy, violent price action, no mercy, no clean trend, just whipsaws as the world tries to price how fast and how far. And if the BOJ raises 0.5% or more and signals aggressive normalization, it's the nuclear option. The yen surges, the carry trade implodes, margin calls everywhere, forced liquidations, flash crashes, circuit breakers, emergency central bank meetings, swap lines activated. This is the global crisis scenario. The system breaks where it's weakest, through leverage. The BOJ is trapped either way. Hold rates down, and inflation consumes the country alive. Raise rates, and the global carry trade detonates. So how do you prepare for February 11th? First, reduce risk. If you're overloaded in US equities, especially tech, especially leverage, cut exposure now. Take profits, raise cash. Do not wait for February 11th. In the nuclear scenario, you won't have time. The market gaps, liquidity vanishes, exits disappear. Second, diversify. One asset class is one failure point. All stocks and you're exposed to the carry unwind. All bonds and you're exposed to yield spikes and foreign selling. All crypto and you're exposed to liquidity drainage. Spread risk across stocks, bonds, cash, real assets, commodities, crypto, precious metals, diversification is survival. Third, watch the yen. The yen is the early warning system. If it starts surging into February 11th, that is the market pricing the hike. That is the unwind starting. That is your signal to go defensive. If it weakens, that is the market leaning toward accommodation. The yen tells the truth before headlines do. Fourth, consider Japanese assets. If Japan normalizes and the yen strengthens, Japanese bonds with rising yields and a strengthening currency beat US duration risk. Japanese equities at lower multiples with improving governance beat US equities priced for perfection. Capital repatriation becomes a tailwind you ride, not a wave that crushes you. Fifth, hold precious metals, gold and silver, because the end game is identical. In crisis, central banks print, Fed QE returns, ECB liquidity returns, money floods the system, hard assets win, and if the BOJ keeps printing instead, the debasement accelerates anyway. Either path leads to metals as protection. So the positioning is clear. Reduce equity risk, diversify, watch the yen, allocate to Japan, hold precious metals, prepare for massive volatility. February 11th is not another meeting. It is the moment Japan decides whether the 30-year experiment continues or ends, whether inflation is fought or ignored, whether the global carry trade is preserved or destroyed. That decision reverberates through every market, every asset class, every portfolio. The Bank of Japan is the most important central bank on the planet right now. Not the Fed, not the ECB, the BOJ. They control the foundation. They control the carry trade. They control the liquidity. And on February 11th, they decide the fate of the global financial system. If you want my exact playbook as this unfolds, exclusive weekly videos, the exact stocks I'm buying, and the millionaire blueprint, join the 100x Club. And make sure you subscribe, turn on notifications, and stay locked in, because what happens next will move faster than most people can react.